Right now, as we watch the ticker move in real time, SoFi Technologies Inc. is trading at exactly $27.84 per share. We are witnessing a robust intraday push, with the stock up $1.12, translating to a green move of 4.19% on the day so far. If you're just glancing at your watch list or checking a notification, you might dismiss this as standard volatility for a high-beta fintech meme. Just another day where growth stock catches a bid because the Nasdaq is having a good morning. That is the expectation, that SoFi is simply a proxy for risk appetite. A stock that moves in sympathy with Tesla stock or Nvidia stock whenever the broader market feels bullish. However, the reality of what is happening inside this price action is far more significant and fundamental. We are not just seeing a speculative bounce, we are seeing the market finally begin to properly price in a structural advantage that SoFi has been building for years, effectively separating itself from the pack of generic neobanks and cementing its status as a legitimate, profitable financial powerhouse. The disconnect between the meme stock reputation of 2021 and the banking execution of today is closing, and that gap is where the opportunity lies. To understand why this move to $27.84 matters, you have to look past the headline number and examine who is buying. The expectation from the retail gallery is that SoFi is a battleground stock, a tug-of-war between retail believers and skeptical short sellers. But the reality of the order flow we are seeing today suggests a different class of buyer. We are seeing the footprint of institutional accumulation, the kind of volume that doesn't just flip for pennies, but positions for quarters. When you see Schwab Intelligent Portfolios rebalancing or large block trades hitting the tape, it signals that the smart money is no longer treating this as a speculative flyer, but as a core holding in the future of finance. The narrative is shifting from "will they survive" to "how big is the moat?" And today's 4.19% gain is the market waking up to the answer. Let's establish the common ground here. Most people know SoFi for its roots in student loan refinancing. If you ask a casual observer, they might tell you it's a great app for refinancing law school debt, or perhaps a place to dabble in online investment. That is the legacy brand perception. It is viewed as a niche lender that expanded into a few other verticals. But if you hold that view, you are missing the absolute powerhouse engine that is currently driving this stock price. The contrarian take, and the reason we are seeing this buying pressure, is that SoFi is no longer just a lender, it is becoming the AWS of fintech. Through its ownership of Galileo and Technisys, SoFi doesn't just power its own SoFi Invest platform, it powers the infrastructure for dozens of other fintechs and neobanks. Every time you hear about investment help or self-investing apps popping up, there is a decent chance SoFi is collecting a toll on the back end. This tech platform revenue is the hidden jewel that the market is starting to price in, realizing that SoFi is a technology company with a bank charter attached, not just a bank trying to use technology. Analyzing the specific intraday movement we are seeing right now, the volume profile is incredibly telling. Usually on a move of 4% or more, you might see exhaustion by midday, where the early morning buyers take profits and the stock fades. Today, we are seeing sustained buying pressure on every dip. This indicates that the float is being absorbed by long-term holders rather than day traders. It is reminiscent of the early accumulation phases we saw in Apple stock years ago, where the ecosystem stickiness became too obvious to ignore. When users join SoFi, they don't just open an account, they enter a financial services productivity loop. They might start with a high-yield savings account, then realize they can get points for using the SoFi trading platform, then refinance a loan, and eventually take out a mortgage. This cross-selling ability significantly lowers the customer acquisition cost, which is the holy grail in the world of online investing. while competitors like Robinhood are fighting tooth and nail to diversify away from just being a Robinhood stock trading app or a Robinhood crypto wallet. SoFi has already built the full suite. Let's examine the competitive landscape, because that is where the valuation argument really gets interesting. If you look at Interactive Brokers, you see a platform designed for the serious, almost professional trader. The Interactive Brokers trading interface is powerful, but it's complex. It intimidates the average person who just wants to set up an IRA. On the other side, you have Fidelity. Fidelity investments are the gold standard for safety. If you walk into a Fidelity brokerage office or use the Fidelity mobile app, you know your money is safe, but the user experience can sometimes feel like it was built for your parents. SoFi sits perfectly in the middle. It offers the sleek, gamified, easy-to-use interface that attracts the user who might otherwise go to Robinhood for Robinhood fractional shares. But it backs it up with a national bank charter, FDIC insurance, and a level of trust that approaches Fidelity Wealth Management. This Goldilocks zone is allowing them to steal market share from both the legacy incumbents and the reckless startups. The financials supporting this move are equally compelling. For a long time, the knock on SoFi was that it wasn't profitable on a GAAP basis. Growth at all costs was the mantra, and Wall Street eventually turned its back on that strategy. However, recent quarters have shown a decisive turn. The company has demonstrated not just adjusted EBITDA profitability, but real hard GAAP net income. This is the turning point that institutional algorithms look for. Once a company crosses that threshold from money loser to money maker, it becomes eligible for inclusion in different indices and attracts a much more conservative style of capital. Think pension funds and endowments that wouldn't touch a speculative fintech, but will happily buy a profitable digital bank. We are likely seeing some of that rotation today. The skepticism regarding their loan book performance in a high-rate environment has also been largely refuted by the data. Their borrowers have high FICO scores and high incomes, proving resilient even as the broader economy shows cracks. One of the most critical aspects of the SoFi thesis is the bank charter. We cannot overstate how important this is. Before the charter, SoFi had to rely on warehouse lines of credit to fund its loans, essentially borrowing money at wholesale rates to lend it out. Now with the charter, they can fund their loans using their own members' deposits. This lowers their cost of funding dramatically. Every time you see an ad for SoFi Checking and Savings offering a high APY, that is actually a strategic move to gather low-cost capital that they can then lend out at a higher margin. This spread, or net interest margin, is expanding while traditional banks are seeing theirs compress. While SoFi Investing gets the headlines, the banking engine room is generating the cash flow that fuels the growth. It's a model that SoFi Robo-Advisor products and SoFi Active Investing tools sit on top of, creating a diversified revenue stream that isn't solely dependent on one economic outcome. I want to pause here and get your take on this ecosystem approach. It's one thing to use an app for trading, but another to use it for everything from your paycheck direct deposit to your mortgage. Comment below how many shares of SoFi you currently hold, and more importantly, do you use their banking products or just the investment platform? I'm curious if the flywheel effect is actually working for you as a user, or if you still split your finances across Fidelity IRAs and Robinhood cash management. Let me know in the comments. Returning to the chart and the broader market implications, we have to talk about the technology sector's influence. SoFi trades with a high correlation to tech, yet it is fundamentally a bank. This duality is its superpower and its kryptonite. When tech flies, SoFi flies. When banks rally, SoFi can rally. But it also means it gets punished twice as hard when both sectors are weak. But the current environment is unique. We are seeing a potential plateau in interest rates, which is the dream scenario for SoFi. If rates stay high, their net interest income remains robust because they earn more on their loans. If rates drop, Their refinancing business, which has been dormant during the rate hike cycle, will absolutely explode. Thousands of people holding high-interest debt will rush to refinance, and SoFi is the brand name in that space. They are essentially hedged against the macro environment in a way that pure-play tech stocks or pure-play banks are not. Furthermore, we need to look at the innovation pipeline. SoFi isn't standing still. They are aggressively expanding into credit cards, insurance, and more complex investment vehicles. The launch of alternative asset investing and the potential for deeper integration of cryptocurrency services safely and consistently with regulations keeps them on the cutting edge. While Robinhood Investments might offer crypto, SoFi offers it within the wrapper of a bank, which appeals to a demographic that is curious about digital assets but terrified of FTX-style collapses. Trust is the new currency in fintech, and SoFi has spent the last 3 years